Welcome to the course. Nice to see you. Let's start right into it, right? So first, we will talk about microstructure. It's pretty important you grasp it up because this is the most important concept in order to understand price action. If you understand this concept in price action, everything else will end up pulling together, okay? So listen closely. If you do not understand the first time, no problem. Go ahead and watch it multiple times. So first, the market structure is going to be this way. Like this. An impulse, retracement, impulse, retracement, impulse, retracement, impulse, retracement. Okay? That's going to be our market structure. Of course, sometimes it's not gonna retrace all the way here. Sometimes it might retrace like this, okay? Sometimes it might do that. But overall, the point is not how long the retracement is. The point is seeing the structure, that is the impulse, to the retracement. And from the retracement, the next impulse. Okay, that's our structure. So let's go over a few examples and then we'll go to the next thing. Basically, we can see over here. Let's see. Impulse, boom. So this is our structure. Our structure is this. We go to the 0.50% of the retracement, which is very important. That's where we're gonna be entering later on the strategy. 0.50%. We see this, we like this, we continue lower, we take the low. This time we broke this structure because this was our high. However, we broke structure and we're in that type of ranging market over here. So no real view where we're going, okay? Also, this will be our new structure. We will be looking for this to hold the 0.50%. So as you can see here, 0.50% goes a little bit, but ends up not working and going lower, right? Let's see a few more examples. Here we take this high, but we're still in a downtrending market. One point that you need to grasp up is not because we just have a breaking structure, it's gonna change and we're now gonna go all the way here like this and continue our trend. No. In further points, we're gonna be talking about liquidity. And that's a very important point to talk about when we're seeing structure. Because many times we will break structure to generate liquidity but end up going the opposite way because there's higher time frames such as the daily and the weekly, which will have bigger weight on the price action than an hourly chart. With that said, let's continue. We can see this is the structure, 0.50%. What does it do? Rejects, goes lower, but ends up going past through it and going through it. We usually want to see 0.50% react on the price. Now we have this structure. As you can see, 0.50 goes higher, fails, goes lower, then we have a big reaction, then we continue, and now which is our structure? This is our structure right here. Okay, so now we have this current structure. I think you by this point should have understood pretty much what structure is and how it looks. It's big impulses to where price stops and then retraces. Now let's talk about a change in structure. Change in structures will look like this. Okay, A change in structure will be we break the previous low of the bullish structure, then we retrace to a premium. We'll talk about that later on, but it's above the 50% and continue to break the lows. In a bullish structure, we break highs and make higher lows. That's how it works. And on a bearish structure, we break lows and make lower highs. That's how structure looks on both ways. Okay, now let's look for bearish structures. Okay, so here, structure of our big impulse, boom, break it with big impulse down, displacement. What do we do next? We go to the 0.50% right here, touch it, reject, go lower. What do we do next? We go over, pretty much almost taking the high, but eventually reject it. Again, what do we do? Same thing, almost took the high, but eventually went lower. Now, do we count this as our structure? Not really, because does this look very strong to you? No. Which would look this? So 0.50, reject, but end up going higher, lower. Now, here we have what? These very small impulses. Sometimes price action will look like this, but I'll probably wait on most of those and wait for a big impulse such as this. In this case, it didn't even retrace all the way here, and sometimes that will happen. Okay, but that's how a bearish structure would look. You want to see big impulses down, you want to see retracement, continuation lower, and this is how a change in structure would mostly look to you. Most of the times we will have a range, and then we go for the lows, we go higher, then we end up going for the lows again, and then we have the big impulse. That's when we have the big impulse after taking lows multiple times, which we will call liquidity. That's when we know it's most likely a change in structure, at least for the short term. Okay, not a change in a trend, but a change in a few days of structure, which we can take multiple trades in. Okay, this time it doesn't retrace all the way there, normal, like I mentioned. Which would be our structure? Well, it would be this. We retrace, go higher, again structure would be this. We didn't go all the way there, and we go higher, boom, and here we're just in a ranging market, no real displacements. Then we go lower, we go higher, range, like I mentioned, pretty hard to guess in these kind of low volume places. Most of the times I would recommend for you to wait for high volume structures, such as this, okay? I would recommend you to wait for those, because most of those times you can see as you develop your path that you can guess when a market is likely to reverse, such as in this case, or when it's likely to continue higher, such as in this case. Okay, but with that said, that was our structure class, and watch it multiple times if you didn't grasp it. Okay, so now we're gonna be talking about fair value gaps on this case. What's a fair value gap? Fair value gap, it's a way of seeing real displacement, real institutional buying or selling. Okay, so fair value gap will be the price in which there's no intersection of 1, 2, and 3 candles. Okay, 1, 2, 3. when the wicks of those candles do not intersect, okay, and we have all of this volume, that's our fair value gap. Okay, which else would be a fair value gap? Right here would be a fair value gap. Okay, this is a fair value gap. Yes. This is a fair value gap. Yes. This is a bearish fair value gap. Yes. Okay, that's fair value gaps. Such as this. This is a fair value gap. Okay. Now, with that being said, okay, what are we looking for? So a fair value gap, which we're looking for, is showing us real displacement. When I mean displacement, I mean impulses, big impulses. So we want to see fair value gaps where, if we are in a bullish market, we want to see price respect fair value gaps where below 0.50%. Okay, we want to see it respected below 0.50%. We do not care about the ones above, such as this. We care about these ones. Like here, we see a big impulse. That's when we know, okay, fair value gap is being respected, right? For example, take another one. Right here. This, when, if, both words, when and if we get over here, we would want to see this being respected because it's below 0.50%, especially this part of the fair value gap. Okay, this part, all of this, right? We want to see price not close below it. That's what I mean respect. We don't want to see a price closure below this fair value gap. If we close below this line that I marked there, it will be mostly bearish and we will end up going for all of these lows. Doesn't mean we're gonna change structure, but means we're probably gonna get all of this liquidity and then we might change structure again and continue higher. But we don't care about that later. We care about the current trade. So take another example. Where's the fair value gap? Fair value gap is over here. We want to see price respect, right? We want to see the price respect that fair value gap, which ends up happening. And we do not care if price closes above this fair value gap. Okay, why? Because it's not in a premium. Since it's not in a 0.50% above it, we do not care. Fair value gaps are pretty important, but why are they important? Because they can show us how price is moving. If we can see how the order flow is moving, such as here, which we end up closing above here, right there, we end up going for the highs, and then what? We go lower. Yeah, well, we don't care. We care about the current trade. Okay? Same thing happens here. What's the fair value gap we want to see respected? The one here. So we see price closing above and not really respecting the fair value gaps, neither the 0.50%. So price ends up going higher. Okay, that's fair value gaps. That's how we use them. We use them to see how order flow is playing out, and we use them to see if price is actually having big displacements. Because look at all the times there's big fair value gaps. Price just continues lower and lower, right? Price just continues lower, going lower and lower, or going higher, higher, higher. If there's no fair value gaps, there's no displacement. If there's no displacement, there's no trade. Okay? So that's fair value gap. Now we're going to be talking about order blocks. So order blocks is a topic which most of the people care a lot about it, but me personally, I don't really even take it into consideration. Rather, there are some particular cases. However, it's an important topic for some people because some people do implement it into their strategy as a key concept. It's a key concept of smart money concepts. However, most people will end up choosing between fair value gaps or order blocks. Me personally, I go for fair value gaps. However, I have students which prefer order blocks. It's your personal opinion, there's no better one. However, I will teach it to you. So, same thing, we're in a structure. In our structure, there will be down candles. Those down candles before key concept, key word, before the big expansion and the new change in structure will be our order blocks in a bullish market. The down candles. Why? Because who was buying before the big movement downwards? Well, they were buying in the down candle. Why? Because they were buying as price was going lower. As price was going lower, the big people, they were buying more because price is cheaper. So they were buying cheaper. So price goes lower into this order block and they will get more orders, which happens here. Ends up going higher. Again, same concept on the downwards. We will have this as our order block. Okay? However, price does not go all the way there. You see why sometimes I say I do not use it? The people that use order blocks will have a higher risk to reward. Why? Because they will end up getting inside the trade here with a stop loss here. Or inside the trade here with a stop loss here. However, the people that trade the fair value gap will end up getting, let's say, for example, here. And most of the times they will get into the trade. The people that play the order block will not get into the trade, such as it happened here. However, we can see that in other times it will end up entering the trade, which they will get a higher risk to reward. Here we see price going into the order block. Remember, down candle before the change in structure. Down, touches it, goes higher. Perfect for you. Same theme. Here, order block, touches it. Here's the structure. Higher, touches, higher. So the people playing the fair value gap, they will end up getting into the trade, for example, right here, let's say, or even at the top of the order block, right there, okay? That will be someone playing the fair value gap. However, the order block person will enter here, which will get a higher risk to reward, as you can see, right here, 4.64, and the fair value back 3.5. So the other one will get 1.1 more risk to reward. And that's in this example. In the other example, as this one, look at the risk to reward. The risk to reward was 4 risk to reward, and the fair value gap person, let's say he entered right here, he would get up what? 1.56. So you can see he gets 2.5 more risk to reward. 2.5 risk to reward more than the person from the fair value gap. So of course sometimes it will pay to go into the order block. Perfect, you can use it. However, most times it will not touch it. In ranging markets such as these ones, which is not very clear, it will touch the other blocks, okay, in ranging markets. However, in a trending market such as this one with big displacements, it will not go all the way here most of the times and then go lower. It will sometimes, as we've seen multiple examples. However, you will end up missing a lot of trades if you try to do that. So you can know when to use order blocks, or you can choose one and not change your outcome. Doesn't matter what market you're in. Okay? That's what you need to know. Let's give a few more examples. So here we see trending markets, order blocks. I would do all of this order block. We never went into it because why? We're trending. We're going lower, lower. This is our structure. We touch the fair value gap, not even the fair value gap, just the 0.50. We react to it, go lower. Same thing here. 0.50. We go to the fair value gap, yes, for barely. Okay, lower. And as you can see, that's how price moves most of the times in trending markets. In downward markets, the order blocks will be the up candles, right? I want to find some examples because as you can see in trending markets, most of the times we will not touch the order block, as I already mentioned. So that's why I do not use it. However, we can find some examples in Extend, but it's hard to look for them once we're trending. In a downward market, right here. Okay, so this would be our order block, as you can see. We go up, there we have our fair value gap, which we respect into certain way. We never actually closed above with strength, you know, like this, and then boom, reacted lower. And price was going into the order block in this case and respected the order block, right? But most times it will not do that. But this is our order block in a down case. And here, for example, we have more order blocks right there. As you can see, in this we go for the order block in the trending upwards market, right? Because our order block will be this down candle. Then in the down market, we have our order block right there. Order block is not only one candle, okay? I want you to understand this. Order block is the last few candles. So in this case, of course, I use the fair value gap because I already mentioned I use it. But if you were to use the order block, you might think to yourself, okay, what's the probability of going to the last up candle, right? Like going all the way here and then just collapsing. Okay, it might do it. We've seen it does it. But also you can consider using all of these candles, right? All of these candles, you can use them. All of these right here. That will be also your order block because it's a block. It's not only one candle. Same thing here. It's not this candle, not this. It's all of these down candles. Some point that I want to make clear. All of these, which you see doesn't end up going to. But that's the order block. So it's in a upward markets, it's the down candles. In a down market, it's the up candles. Because why the up candles? If we're thinking about price going lower, where did the people sell? They sell once price was going higher. So that's the order block. However, as I mentioned, and this will be the last time, choose wisely when to use which. In trending markets, most of the times I recommend fair value gaps. You will not get the order block, and once you get the order block, this will happen most of the times. So fair value gaps are the cleanest, they're the best in my experience, and I would stick to them because you will have more trades and you will know when you're wrong in a trade to exit early without having a loss. So now we're going to be talking about what it is, this pretty important concept which you already heard me say, premium and discount. So premium and discount, it's basically, premium is everything above 0.50% and discount is everything below 0.50%. When we're looking for trades, we're looking, if we're in the long side, we're looking for discount. Why? Because we want to buy when price is cheap. Cheap to what? Relatively to the previous move. The structure. So we want to buy when price is cheap. Once price is cheap, we can start looking for entries all over here. Okay? We do not look for any entry here. Once price is here, no entries. Price can do whatever it wants. It can continue going higher. We do not care. Okay? We don't care if price continues and continues higher. What we care is once price goes lower. Once the price goes lower, we're looking for trades. If it continues higher, we'll just look for the new structure. Once we have the new structure, we enter the trade, right? That's what we're looking for. Now, in the short side, we're looking for the opposite. We're looking for anything above premium to look for shorts, and anything in a discount, which would be below 0.50%, we're not looking for any short because price is not cheap. Price is not expensive, sorry. Price is not expensive. And if we're selling when price is not expensive, we'll end up regretting, right? We want to sell when price is expensive and we want to buy when price is cheap. That's the key concept. Also, key concept, we do not care, like I already said in previous videos, if there's a fair value gap or order block, for example, in a discount when we're in a premium market, in a down market. We only care about the PD arrays. What's a PD array? Premium discount arrays. So we only care about the PDAs that are on a premium. And that's why we want to see price respect, price displays from. If we see price do that, we see that order flow is on our side. And what do we do if we see order flow is on our side? We continue with our down bias. Same thing here. We do not care about anything that price is over on what? On a premium. So we wouldn't enter here, 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 nothing. We would only enter here, below here. Same thing happens here. In this case, we take the high, we end up going lower, which is a very dangerous sign. And what will be our structure? Right here. But now, do we have displacement? No. So there's no trade there for 1 point. Because did we break this structure with displacement? No. So there's no trade. I already mentioned, no displacement, no trade. You see this, you exit if you were all the way from here. Because we took this high, we end up going lower, no displacement, you're done. Okay? And that's how premium and discount works. So basically right here you have this structure, we break it. Now you have this structure, we end up almost taking. Now what do? We go lower. I will take this structure. Why this? Because we shouldn't go all the way here again. This high should be respected. Now what do we have? We have this fair value gap. We also have this high, which is some liquidity. And we end up touching the 0.50, which is a premium, and that's what we want to see. You could end up even waiting for the closure and, for example, going with a tighter stop. but in my opinion it's better just to enter directly at there with a bigger stop, because markets are volatile and you do not know if it touches it and then goes higher, touches your stop, goes lower. Okay, so keep it more simple, keep it with the rules. Okay, with that said, that's premium and discount, pretty important topic, and go into your charts, see it, see how price reacts, and start implementing. Okay, now I want to talk about liquidity. What is liquidity? Okay, so for liquidity I like to go to weekly charts, for example, because liquidity most of the times will be at higher time frame points. Which are higher time frame points? Previous higher time frame highs and lows, which are previous week highs and lows. So there's a lot of liquidity at the previous week high, and there's a lot of liquidity at the previous week low. Also, there's a lot of liquidity at swing points. What's a swing point? Swing high is, because I didn't explain this, if you don't know, a swing high is this, for example. Take it into consideration. So a swing high, well, this is hard to grasp. A swing high is basically, look at my cursor, is one candle, two candles, three candles, the candle that it's the highest among three candles. That's a swing high. So this is a swing high. Okay, that's a swing high. Now that we know what's a swing high, we have this swing high over here. So this has a ton of liquidity. Why? Because people put their stop loss at swing highs. And what's a swing low? So you understand, swing low is the opposite. 1, 2, 3. The lowest of the three candles. 1, 2, 3. This is a swing low. Okay? You see how higher. So higher, lower, higher. This is a swing. Such as this is a swing as well. Okay? This is also a swing low. Now, there's swings to swings. There's structure swing lows, which will have the most liquidity. Structure swing lows, which what are those? The swings that made the big movement up. Okay, that's our structure swing low. And there's just swing lows, such as this, which will have liquidity. Also will have liquidity. Why? Because there's lower structure points there. There will be, in the 1 hour, there most likely will be a structure there which hasn't been touched at all, and price has never gone over there again. So there will be a lot of people which trade, for example, support and demand, or whatever you want. I don't know what other key concepts they might do, but I know most people tend to do support and demand. That's the most common among retail, but this will be counted for them as their support. As you can see, it does play sometimes 1, 2, 3, it does touch it, but eventually it breaks it. Okay, eventually price trades through it. Okay, price trades through it, goes lower, so it has no utility. It's just a point of liquidity. That's what it is, a point of liquidity, because some traders will put their stops there. Okay, that's the swings. And also for the down, there will be swings which will have a ton of liquidity in the down structure. Okay, for example, here we broke structure. What will be our structure right here? This is our structure. So we go higher, we touch this order block, we go lower. Okay, well, then what do? We have this structure, we break the structure on the weekly, And then what do? We do this, lower into what? Discount, higher. Same thing here, discount, higher. Then we're in a ranging market, then we go higher. And now we're right here in this structure. Okay, so that's our swing points. Point that I needed to explain because I haven't previously explained to you. And those will have a ton of liquidity. Also, the swings will have liquidity, yeah, but not the same amount as these ones. Also, the points, like I already mentioned, previous week's highs and lows will have a lot of liquidity, a lot. So if we see price take a swing high, swing previous week high, we want to see how price reacts on lower time frames, because how price reacts on lower time frames will tell us a lot about what price does. For example, we're taking this previous week high right now, right? We had a closure above it. Now, right here, we closed above, and we're looking like we're closing above it most likely. But we could close below. If we close below, we want to see other time frames, like such as 1 hour is bullish. Daily, it's in a it's in a bullish structure, to be fair, right here. Hasn't really broken it. And it touched order block and reacted. And also the previous candle closed also bullish, so this candle is most likely to be taken. With that said, there's a lot of liquidity here. Why here? Because here is the other day's high, which also has liquidity. Previous day highs and previous day lows will have a lot of liquidity. Such as you can see here, we take the previous day high, we close below, boom, then we have big displacement lower, we break structure, then what we do, we do not go to the premium, and we go lower, right? So that's liquidity points as well. That's a lot of liquidity. And that's liquidity. Liquidity will be previous week, so you grasp it up. Liquidity will be swing lows and swing highs. Previous week's highs, previous week's lows. Previous day highs and previous day's lows. Go look into your charts, learn what I'm saying, and once you've done that, watch the video multiple times, understand what I mean with liquidity, why it's important, and how price reacts once it takes liquidity. We will, in further topics, we will talk about how to implement it into the strategy. But I want you to understand why we implement it like that and how price reacts. So when you are trading and you see price taking liquidity, you are not the liquidity. Okay? And what I mean with liquidity, liquidity is all the places in which a previous buyer can sell its previous buys. So a buyer that was buying all the way here can sell to you here once, not you, but I mean other people, which are breakout traders or support and resistance, like, oh, we broke resistance, now it's support where I'm entering, you know, like, okay, all of those people will buy to them and they will be selling to them. Why? Because they do not care. Those people don't look into previous week highs, they don't look into previous day highs, previous hour highs, structure, etc. They're just looking into lines which they consider as support and resistance, which it might work sometimes, but in the long run it does not work as efficient. I'm not saying it doesn't work, I'm saying it does not work as efficient as learning liquidity, premium discount, and structure. Those concepts are what you need to understand when markets are likely to continue or fail. And sometimes you will be in the fail side, but if you can be in the winning side most of the times, you're good to go. Okay? So that's liquidity. I'll see you in the next. Okay, now we're going to be talking about market maker sell or buy models. Okay, market maker buy or sell models are basically, let's go to a blank chart. Let's go to a monthly. Let's reset it. Let's move this. And let's do this. Market maker buy or sell models. Actually, let's do this. What the hell? Perfect. Market maker buy or sell models. This is something really, really, really nice. Okay, let's look for this right here. This is a market maker buy or sell model. Okay, let's remove this. Perfect. This is a market maker buy or sell model. First impulse, accumulation. Second impulse, accumulation. Third impulse, distribution. And then we change to this. Okay, this is a market maker buy model right here. Let's remove this. This is the first accumulation phase, second accumulation phase, reversal, first distribution phase, second distribution phase, reversal, and it repeats on and on and on. Okay? You're probably seeing this in the market and you see, okay, this is exactly how the market operates. Yep, that's exactly how the market operates. Okay? It will induce liquidity once a higher time frame PD array is tapped. Once a higher time frame PD array is tapped, same thing over here. We can expect price to do a reversal, short term or long term, depending on the time frame we're looking at, because this is fractal on every single time frame. Okay, so first accumulation, second accumulation, reversal phase, first distribution, second distribution, reversal phase, and so on. Let's remove this and let's go to the chart. Where's the higher time frame? Right here. Accumulation, reversal. Okay, reversal, first accumulation, second accumulation, remember they accumulate at the up candles, reversal, first accumulation, second accumulation, reversal, this was a short accumulation, reversed after taking these stops right here. This was a long accumulation for a while, even years, 4 years accumulation. This was the first accumulation after leaving the range. I would consider this event, because this is a big range, I would consider this the reversal phase, because as you can see it's below the range. So this will be the reversal. Below the range, accumulate. First accumulation actually right here, second right here, and after taking the liquidity over here, this is the reversal phase, in my opinion. Okay, I could be wrong, we could head all the way over here, it's likely, I don't know. I do not control the markets, but I look in probabilities. Okay, this could be their second accumulation phase, but for me, in my experience, it looks more like a reversal. So where they took some distribution here, okay, above this high, we distribute, okay, then head lower. Okay, how can we know? Well, we have to start disrespecting bullish arrays. Accumulating something like this, distribute, accumulate, distribute. Here we can think, okay, this would be our reversal phase. We're at 98. That's how you see a market maker, and it's the same on all the lower time frames. Accumulation, accumulation, another phase of accumulation, reversal right here, expands, accumulation, accumulation, reversal, accumulation below these lows, first accumulation, second accumulation, and where is it likely for us to then explode to? These highs, and on the highs, reversal to go lower, reversal, accumulation, accumulation, then our distribution reversal, then we just accumulate again, and then we reverse. But note something about this. Can you see here something, some pattern? The same places where price accumulated at, it's the same places it's going to try to accumulate at as well. It accumulated here, it starts accumulating there over again. It accumulated here, it accumulates over here again. Okay, it accumulated here, it accumulates over here again. And same thing here. Once we break through, we accumulate. Once we break through, we accumulate. Once we break through the zones of accumulation of a downtrend, then it accumulates there. What's the next zone? This was the next zone of accumulation. We accumulate over there. You can see this is the accumulation zone. We accumulate there over again. Then we distribute. We have our reversal right here below the lows. Where was our phase of accumulation? Right here. We accumulate again. Second phase on this down candle because they buy on the down candles. We accumulate over there again. Where was the other accumulation? There. We accumulate over again. And where's the other accumulation? Right here. This was the reversal accumulation. We accumulate over here again. This is the last, in my opinion, and I will take these stops where reverse for going lower. Okay, that's market maker buy or sell models. Okay, we're almost done with the curves. Now we're gonna be talking about one of the best trading tools that you will have for your bias, not for your entry, because this is not an entry tool. This is a confirmation tool. Once you do have a bias, you can use this as a confirmation tool. Euro and the bonds, they're pretty similar. Okay, let's do this. No, this looks terrible. Let's do this. CB1. I don't know what's going on. Trading views kind of pretty slow, so let's give it a minute. These are the treasuries. Okay, if you made it this far on the course, congratulations, you're showing strength. This is where the best comes, so it will pay off. Okay, as you can see here, Look, these are correlated, right? Are they going all down together? Of course. Is there any sick pair and everything of that nature? Of course, this was sick pairs, because look how they're going higher, and look how this CB1 is going lower without any difficulty. It's just going lower, 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 lower. And these ones are having some kind of issue, especially CF1. It's the most sick. It's taking stop losses every time it has the opportunity. It will knife you down. Okay? If you're looking for counter trend trades, then you go for this one because you're looking longs. But if you're looking for trend trades, which is shorts, then you're looking for this one, CB1. But look at this. This is an SMT divergence, smart money technique divergence. We have a low, we have a higher low right here. And what do we have here? A higher low. Okay. If these assets are correlated, then why is this making a lower low and these ones are making higher lows? Because there's been a massive accumulation down there. I'll show you an example of real data of what I'm expecting with my bias. Okay, look at the correlation. Look right here. Okay, right here. You see? CB1 was making lower high. This was making higher high. These ones were making higher. Actually, no. This one also made a lower low. So lower low, higher high, and lower low. And lower high, my bad. And we're in an accumulation above previous highs. Okay, so we're thinking, okay, there's an SMT divergence above liquidity. This looks kind of curious. This looks like a manipulation accumulation of our market maker buy or sell model. In this case, it's a sell model. So anytime we get a displacement of this range, or a PD array such as this bullish order block is respected, and we trade through the range, I'm expecting some kind of shorts. And what does happen? Market goes lower. Okay. We understand? Look at this right here. There's no SMT divergence right here, right? All of them are making higher lows. Yep, okay, perfect. Let's look at Euro. Sorry, my bad. Let's look at Euro. What is Euro doing right here? Euro is making higher lows. They're correlated, it's okay. What's doing GBP? GBP, it's making higher lows. What's doing CHF? Ooh la la! CHF, it's making a higher high right here. It taps into the high. Okay, we have one divergence with a highly correlated asset. What else do we have here? Let's go to DXY. What is this DXY doing right here? Can you tell me? DXY right here, 21 of October. It's a higher high. Okay. What is Euro doing that same day? 21 of October. What is the other day? Right here. It's making a higher low. So we have a divergence right there as well. And we're starting to respect bullish arrays. So we're thinking, oh, there's a massive accumulation below these lows, and we're likely to reverse. Understood? We do not just look at the divergence and put a trade. We have to have a context behind it, such as this one, that it's happening right now. We're below these lows, right here. There's a divergence. So it's likely for us, if we start respecting bullish arrays, to make an expansion upwards again. Okay, I'm not calling any bottom. I don't want to. I don't need to. There's still liquidity down here, it's true. And it will be, in my opinion, the probable bottom. But in the short term, weeks, it's likely to at least give a retracement. Where? To the bullish order block, right here. To the bearish order block, my bad. Right here. And it's a nice trading opportunity for us to capitalize on it, okay? So that's it for SMT divergence. You can look for it on any asset. I will show the last, okay? Nasdaq, and this is it. Okay. US 500 USD, SPX then. Okay. Oh, ooh la la. Divergence right here. Lower high, higher high. Right? Can we see this market? Are they not extremely correlated? I'm looking at them, they're literally the same market. Which was the sixth pair? SPX is making higher highs. Nasdaq, it's not really. Look at the down. Boom, down. This was a sick pair. What's happening here? Look. You see? Let's go look. We have this divergence, right? That I already showed to you. Let's look to another one that is highly correlated. You're probably knowing which one I mean. Look, we had the divergence as well, right? We made the lows as well, right? They're all correlated. So we had a divergence right here, which indicates above highs accumulation. And we're looking for shorts where specific on Nasdaq. Anytime we get a displacement, fair value gap, we enter short. Where's our target? On these lows right here that had the liquidity, which eventually gets tapped. And it's also a nice round number, which is 10,000. Okay. Now look at this. What are we seeing here? Can we see anything? Look. In all this rally higher, they're all rallying together. They're all correlated, right? Now let's get a closer look. Look at the weekly. What are we seeing here? The Dow, it's running lower, okay? Dow is running lower, while these ones are on a consolidation. So this is the relative strength analysis, like I already taught you, okay? Also, let's take a look. Can we see something here on the daily chart? Well, we're going higher. What's going here? Look, we had this order block. all the way here. We disrespected, then we change bullish for a while. Okay? We tapped into the rejection, was placed lower. And while Dow is nuking and SPX is nuking, Nasdaq is in a consolidation. So why would you be looking for shorts on Nasdaq? It makes no sense. If you know you're bearish, you're looking for shorts on DAX, on Dow, or on SPX. And if you're looking for longs, you're looking for longs on Nasdaq because it's the sick pair. It's the one that's not going to displace higher, lower. But whenever it's going to displace higher and have a bullish wick, oh, it's going to displace really big, such as this candle you can see right here. Okay? Look at the order flow. That is clearly bearish. Now let's look something like DAX. Can you see the market maker buy model or sell model like I already mentioned? We take the stop losses, we distribute. What's likely to happen here? Well, we're going to accumulate where? Where did we accumulate? Right here. We're going to reaccumulate, then we're going to displace lower, reaccumulate. I'm not saying we should get all the way here. I'm not saying that, but it's likely to. Okay, at least here for the liquidity, because if we go to a monthly chart, I don't really use DAX for SMTs, but the DAX is making a higher high, and these ones are not really making a higher high. Okay, now let's go to the FTSE. FTSE is making a higher high as well, and the American indexes are not. Am I bearish on American indexes? Well, order flow is on the weekly. Let's remove this. Order flow on the weekly, it's 100% bearish without a doubt. We disrespected this order block, we disrespected, well, we're actually respecting this fair value gap. But we still have liquidity over here. We never tapped into the breaker unless you did a retrade and not a retrace. Once it trades here, you enter on the retrade, your stop will be something like this, your target will be those highs right here, and that's your trade done. You don't necessarily need to target these highs. Okay, so that's it, and I hope it worked for you. Well, today we're going to be talking about relative strength analysis. Okay, relative strength analysis is for us to know when we should buy or sell currency that is correlated to another one. For example, when do we want to buy euro, or when do we want to buy GBP, or when do we want to sell euro, or when do we want to sell GBP. For example, here we have this. Let's put this right here. Let's put GBP. Okay, let's change the colors so it looks exactly the same, as you can see. There we go. Okay, we do a run lower. Look at the cursors on both screens. We run lower, then we run higher. Okay, I want to change this to euro. Okay, we run lower, then we run higher. Okay, then this destroys the order block and the swing low right here. GBP doesn't, so we're looking that GBP is more bullish. So if we're looking for shorts, we're looking for shorts at euro, okay, at this point. So we're looking for shorts here, we short. Then what happens? GBP is displacing lower, while euro is ranging. GBP displays lower. Then we have an imbalance here, and right here, and an order block right here. So we're looking now for shorts on GBP. It goes lower. While euro took this high, GBP did it take that high? Nope, it didn't take the high. So which is high? Which is stronger? Euro. So we're looking for sells on GBP, and we're looking sells. GBP is placing lower, while euro is making some kind of retracements. Look, the retracements on euro are much bigger than GBP. GBP retracements are much smaller, okay? Right? And GBP is displaced lower, which would present us more profits, which means more money. And if we're looking days for a counter trend, because on our lower time frames we're bullish, we will be looking for buys at euro, okay? How else can we determine this? Look at this, look at my chart. Look, euro GBP. Right here, what's happening here? We're taking some highs. I already explained to you, if we're in a range, we care about liquidity. So here, it means that GBP is likely to be stronger, and it's stronger here. When GBP touches an order block, it's placed higher, so we're likely to be weaker. Once it touches the rejection block, it is placed lower, so we're likely to be what? We're likely to be lower on euro, because this is euro GBP. So we're looking for shorts on euro. Once we take the liquidity, what are we looking? We're looking for euro to be bullish and GBP to be bearish. So we're looking for shorts on GBP. And look at this. GBP doesn't take the high, euro takes the high. And now we have this order block, which it did get respected right here. We trade down into an order block again. This is your retrade. You enter, boom, this place is higher, and goes bullish where? To the highs. And now what are we expecting? We're expecting GBP to be stronger. So we're looking for buys on GBP, and if we're looking for sells, we're looking for sells on euro. Okay? This is how you do your analysis of strength. And you can do also this with pairs such as AUD and CT, AUD USD, and CT USD. These pairs are highly correlated, okay? These pairs are highly correlated. As you can see, look at my charts. Look at how their movement is, and look how their chart is. It's the exact same thing. We touch a rejection block, okay? Rejection block, we go lower. We go lower. Where are we likely to go? Here. And once price goes for these lows, what is likely to happen? We're likely to go higher again, okay? Because this is a ranging market. Understood? This is how you get your analysis. You follow a crosshair, such as this, and you see the price action on your both correlated pairs, and you select the one that is going to offer you a better movement. And you can do this on lower time frames as well, okay, for each individual day. Okay, this was your analysis strength. Okay, now we're going to be talking about leading pair versus sick pair. On a downtrend, what we would like to see is the following. Okay, we would like to see on a downtrend price eventually want to displace lower, right? And we wouldn't want to see price ran through short-term highs or swing lows or anything of that nature, right? We want to see price respect. Well, in this case, we can see that the following. We have this swing high, right? On GBP. Right here, you can see my cursor on the right, GBP. GBP runs through this high right here and does this. And Euro does the exact same thing. Okay, so they're correlated right now. There's no problem. Then what happens? We displace lower, and we displace lower. However, look, GBP is respecting highs, right? It's respecting. Euro is not. Euro is taking all these highs. As you can see right here, Euro is taking all these highs. And GBP all this time, it only took the high right here. Okay? So Euro is the weak, the sick pair. Okay? It's the sick pair. Then we go lower and lower and lower. And GBP, what is it doing? GBP is consolidating, taking highs, taking highs, taking highs. Every time that Euro makes a rally, GBP takes a high, and Euro is just continuing to tap order blocks, go lower, tap order blocks, go lower, tap order blocks, go lower. And GBP is stalling here, taking highs, taking liquidity. So GBP is the sick pair, and we want to take trades on the leading pair that's going lower. Right here, what's happening? We go lower, and what does Euro do? Euro takes this high. GBP, does it take this high? Not really. GBP does not take the high. Okay, so GBP is now our leading pair, and our sick pair is Euro. So we're looking for shorts on GBP. Once price trades through, we're looking for shorts here. Boom. Displacement, boom. Displacement, boom. You understand? Let's continue. There's this high on Euro right here. You see it? Look at my cursor. And now look at my cursor on the right. What's going on here? We're not taking that high. This is our leading pair. We want to short this because every time that we short it, it's going to have a low resistance liquidity, in the sense it's gonna offer the sell side, all the short is gonna offer without any issue, without no issue. It's just going lower, 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 lower. Okay, it's going lower, dying. And Euro, whenever there's an opportunity, Euro's gonna take the highs because he's sick. He wants the liquidity. Okay. In this case, we do take this, but this is not a swing high. The swing high is all the way here. It does not take any swing high. Okay. So this is still our leadership pair, and Euro is our sick pair. Then we displace lower. We go up, we go down, we go up. Which one is the sick pair? Well, right now we do not know. They're both synchrony, and there's one new bullish trend about for the short term to start, in my opinion. Okay, so basically what we use is the relative strength analysis on this. Okay, we use the relative strength analysis. I'm going to show you last examples: AUD/USD and NZD/USD. Same thing goes here. Can you see it? which is a SIG pair. AUD is the leadership, NCD is the SIG pair. Look at this. Look at this huge value to take the highs. Look at this. It's not making any higher high on AUD, and NCD is making a higher high. Same thing happened here. Look at this. We have this in the short term. We have this. This is because this was our SIG pair. Every time there's a rally, we're going to have a huge rally on NCD, and AUD is not going to show that. Okay? And each time we short, each time we go short, look at the falls on AUD. Boom, boom, boom. Okay? Here they're correlated, but look at this. The SIG pair takes this high, and this doesn't. This has equal highs. Okay? And look at the fall. Look at this huge fall. Look, 2.54, 2.4. Okay? It doesn't really matter how much percentage, since the pair depends on how much the change is, but you can see with your eyes how much bigger the fall is. We fall, we break the structure, we change delivery, we tap into an order block right here, and we go lower. Where? For the liquidity. We take the liquidity, we go higher. AUD was, in this point, AUD was the SIG pair. AUD was the SIG pair, and here the leadership pair was NCD, because the shorts were winning every time. Right here, it was the leadership. As you can see, it recently changed to the SIG pair being NCD and the leadership pair being AUD. But before, look at the price action. NCD was the leadership pair, and AUD was the SIG pair. Okay? So take that into notice with relative strength analysis and with everything I already taught you, because this way it will save you a lot of money. You will know which pair to trade, which pair will make you more money, and which pair is going to be the best. Okay? That's how you're going to look. I don't know why it's not taking me back here. There might be a bug, but look at this, if it lets me. Look. We're taking the stops over here. Okay. But right here we're not taking. Look at this, it was the leadership pair when it was bullish. In bullishness, it didn't take this low. Here it took the low, it took the rejection block, went higher. But here it never took this because it was the leadership pair on bullishness. And on bearishness, this was the SIG pair. Look how it's taking the highs, taking this high, while NCD is making lower lows. Then we have these highs. It runs through them aggressively. NCD is just tapping an order block right here because here is our swing high. Here was the order block, disrespected. And look, it's having a much easier time going lower. And now it's having a much harder time to go lower. And NCD is going lower, AUD is going lower. Okay, so that was it for this lesson. And we're almost done with the course, so let's go to the next. Okay, now we'll be going through what I consider to be the time frame alignment. Okay, time frame alignment is pretty important, very important in my opinion, and I actually believe I believe time is the most important thing in trading. Okay, I believe time is the most important thing that you need to consider, as well the price action and you knowing your things, but you need to know them in a certain time, okay? Because they will repeat, they will look very similar at certain times. In certain different times, it might look different, and it might not repeat as it repeats in certain times, okay? Why? Because if we're thinking of a market, many of the people that enter the market might enter at a similar time, leave the market at a similar time, though making the market subject to those people's changes, okay? So if we know market is very volatile at a certain time, most people will go to that time, making patterns, well, repeat in most cases, and having these predictable in long run patterns, okay? Basically, time, I only use 4 time frames. I do not care about anything else. 4 time frames, that's it, okay? With those 4 time frames, I make most, if not all, of my decisions, okay? Basically, with 2 of those, well, actually 3 of those, I make all of my decisions, and 1 of those, I do it for bias, okay? For a bias for the day, okay? So basically, how I use my time frame is I go for my daily to see what is going on, okay? If I see price just collapsing, and then I see this candle, for example, I wake up that day, I open the market, and then I see this candle the next day, and for example, I see market going here, okay? As you can see, market went there in the London session, okay, perfect. First, it took the previous day high, which means we're likely taking liquidity. Then we have, for example, this big candle, which is a candle in the 1 hour, closing below the previous 1 hour low and taking the previous 1 hour high. Okay, why do I say this? Because previous hours, previous days, high and lows, even in the 5 minute, okay, much less likely to be respected most of the times. However, in the 5 minute, it also happens. In the 1 minute, in my opinion, it doesn't really matter because it can happen whatever happens. I do not take into consideration this that I'm going to say in the 1 minute, but in the 1 hour and in the daily, many times it happens, okay? This is why I take into consideration 1 hour closes. I wait for those 1 hour closes. I wait for those 5 minute closes because for me it is extremely important to see how price reacts to the previous candles low and highs at a certain time, okay? So if we close below and we took the previous hour high, what I'm expecting is continuation, okay? I'm expecting continuation. I will show that, okay? If I see a candle closing below the previous 1 hour low, I am expecting continuation because it was unable to close above it. If on the other side it closes above the previous 1 hour low, I'm not expecting anything, okay? If I'm bearish, I'm not in the trade. I'm expecting nothing. I'm not entering that trade even if in the 5 and in the 1 minute it looks bullish. I expect nothing. I'm not entering into the trade. I'm not longing. I'm not shorting. I'm out. Okay, I'm out. I do not care if it goes down again. I'm out of the market. Okay, in the long run it will save you most of the times. Okay, most of the times it will save you. As you can see here, for example, we closed below the previous hour low, then we go up in that candle. That was trade from yesterday. We close below, then what we do, we open and we go up to where? To a premium.
Okay, we go to a premium. After going to that premium, we go down. Why? Because we closed below. So what do we expect? We expect that low to be great again. But that what happens here? We have 1, 2, 3 attempts of going lower. No closure. Actually, we're attempting again here, touching it 5 times. No close. So if you haven't taken all of your profits, even if you were expecting these lows, in my opinion, it's a bad trade because price is showing you I do not want to go lower. I closed above it 3 times in 15 minutes. So if we think about the 5 minute and we think about the 1 hour as the same, okay, and especially here in this one, because in this one it took the previous 5 hour low and it closed above. So we closed above a 1 hour low in the 5 minute, and we closed above in the 5 minute of another 5 minute low. Okay, so we're having this time frame alignment. Okay, look in the 5 minute how it works the same. Look, we take the high, we go lower. We take the low, we go higher. We take the high, both the low, bring an indecisive candle. We do not know where it's going. We take the low, we go higher. We closed above. Okay, where do we expect to go next? The high, high, high. We take the high, we take the low. Okay, we take the high and the low. Well, I do not know if it did. Okay, it did. Here, it closed, and we didn't take the low or the high. But here we can see that we took the high. We close below, we go down, and look how in the 5 minute it even does the same thing. I'm telling you, it's very important to take this into consideration in your trading. It will save you plenty of times. It's not going to always be the same. You need to take market structure, time. When I mean time, I mean closures, okay? You need to take time, market structure, premium and discount, other things into consideration. It will take you a lot of time. It will take you years. However, if you start with the right things, in those years you will be good. Okay? Okay? Taking into consideration, do not go the easy way, just wanting to do one thing and not learning about all the things. Okay? You do not need to learn all the things, but if you're going to learn one thing, learn it correctly. I'm not telling you to do everything and to, okay, if it take the low, I'm going to short. If it did this, I'm going to long. No, 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 no. I'm not saying that. I'm saying in your strategy, if you see these things, take into consideration what happens if you do not short, if it closes above the 1 hour low. Am I saving me from losses? Or I've seen that even if it closes above, it's not saving me from losses. In my strategy, it does save me from losses. Okay? I do not care if we go for this low. We haven't. I do not care absolutely. In my opinion, in my study, it's likelier to go for this high than to go for this low. It can go for the low, absolutely it can. Okay, absolutely. As you can see here, it happened. We went high, we didn't take this, we never went for the high, and we went lower. Okay, but we have to take here into consideration that the time period in which the trade was the trading was done, there's no volatility. Okay, here there is, so there's likelihood of higher before lower. That's time frame alignment. I use these 3 time frames, and in the 1 minute, as I already explained in the previous lessons, I use it as my fractal. Okay, however, I use the 1 hour and the 5 minute as my diving strategy, and I'll use the 1 minute just to look into, am I looking at a fractal? Am I maybe losing an opportunity of entry to the market because I see, for example, this swing high? Let's take into consideration maybe, let's say, this swing high to this swing low. Okay, is this market structure, then we're bullish, then we're going higher? No. Okay, no. In that certain criteria, no. So that's why I use my 1 minute. And that's why I recommend you to use 3 time frames, okay? Daily, I use it, I'm saying this as a scalper and as a day trader. If you use, I'll say right now the other time frames. If you use for swing trading, I'll show you, but for the daily, I only use it as the same as I use my 1 hour and where I'm expecting the price to go that day. Okay, so if for example I'm inside a trade and I want to take profits at a certain place, let's say this low, I'll mark my low, then I'll go to my daily and I'll see how my price respects. And because I'm a scalper and day trader, I'm not just going to see price showing me unwillingness to go here and hold my trade all over here. Even if I enter the trade, for example, here, I'm not just going to say, okay, I'm going to hold it. I do not care whatever 5 minute and 1 minute do. I'll just wish the best. No, if I see unwillingness as a scalper and day trader, I'll just cut the trade. Okay, even if I end up getting here, because that's the daily bias. Okay, that's in the daily, that's what it's like to deliver, because look, we closed below. Then we went to the low and we touched it and rejected. So is there a high chance of us going here? Of course, there is a high chance. But in my time frame, okay, in my time frame, it's showing me, okay, we're likely to go here in the higher time frame, but we're not likely to go here right now. We could perfectly manipulate if we're going lower into here. Okay, we could perfectly and go lower, and I'm just going to take the loss. No, but if I'm a swing trader, for example, a swing trader could enter, well, in this case, a swing trader, I wouldn't have even an entry here, but for example, a swing trader uses the weekly, which this is your structure, which we broke, okay? Here we had another structure, we broke it, we went into the premium, okay? We're actually inside of this structure. We haven't even left the structure. We're bearish, okay, we're bearish, and we went to a premium again, rejected the premium in the weekly, okay, and once we rejected the premium in the daily, which will be older of your time frame alignment, what is the daily doing? Because remember, in the weekly, if we're bearish, sorry, there will be a point where daily will turn bullish, okay, and put very close attention to what I'm going to say, because if nobody tells you this, you're never going to learn it until years of experience, as happened to myself. When the weekly turns bearish, we just keep going down? Could be, but if you're a swing trader, you're looking at the daily, weekly, and 4 hour, okay, or even the 1 hour. 1 hour, you can also use it, okay? You can use the 1 hour as a swing trader, but the 4 hour is the most common. So here we would see our daily turn bullish, and this will be our structure in the weekly. So where is our premium? Where? Here in this section, from the 50 to the 70. This is our premium, okay? So what are we looking for? If we're thinking, okay, remember, this is time frame alignment and very important. If we're thinking, okay, daily turn bullish, I want a discount of this daily range, which I already showed in previous videos. It was around here, okay, around there, maybe a bit lower, I do not care, okay, it's just a demonstration. And here is my premium. I can target these liquidity points, which eventually get tapped. I could target all of these highs, which eventually did get tapped. It's also 70, so both confluence, and this will be a huge trade, okay? 5, okay, it took a couple of months, okay? But you're a swing trader, so if you're a swing trader, that's what you're going to be holding for weeks and months, okay? So it took about 4 months, about 3-4 months, right? And there's your trade done. If you do 2-3 of these trades per year, and let's say you win an average of 4 risk reward, and you risk about 1% of your total equity, you could be doing, okay, if you do it, as I've already mentioned, 3, 4, okay, you could be doing about 10%, 12% of your money in a year, just trading swing trade. Okay, it's pretty good. As a day trader and a scalper, you might do more, you might do less, okay, because a day trader and scalper will take more trades, will take more losses, okay, will demand more time. So as a day trader and as a scalper, you will have to, of course, adapt to the losses, the commissions that are much bigger because your stop loss is much smaller, and the time demanding and everything. But you might end up having much more than a 12% a year. Okay, I've done myself 8% a month, which of course is really good in my opinion. It's very, very good. But I do not always do 8% a month. In reality, you do not always do it. But if you can do 8% a month, and for example, you do it 2-3 times, well, you can stop the whole year. Okay, you can do 20% a year. You're done. You're done trading. You're done this year, and you can focus. But if you also want to continue, you can end up doing a lot more. Okay, you can end up doing 40-50% a year. Okay, it's a reality. But going back to the development, there we have our trade done. Now, what are we wanting to see in the weekly premium? What do we want to see? We want to see a market structure break indicating that the daily is about to turn bearish again. Where do we have it? Well, we have a manipulation here out of range, manipulation up here of the range, and you think may even stop you out, and you may have taken both losses. Okay, you might, but then you have this market structure break, which is the real one. And of course, if you were only thinking about entering short, you wouldn't have even entered here long. Okay, you wouldn't have entered here long because you were thinking of entering short, right? Because the weekly is bearish. So you might have ended up taking one loss, for example. Now, here it goes again, breaks the structure. You will have entered up around here, for example, here. So you enter, let's say, here in the 50 with your stop loss here, and you were going to target, of course, this low. Okay, which eventually, in my opinion, it's going to be tapped because the structure is still bearish. Okay, it's still bearish, it hasn't changed. The most likelihood it's going to go there, right? It might not, we do not know, the market is never 100%, but in the most likelihood it's going to. And there's another 5 risk reward that it's potential to be touched. Okay, even if you are super greedy, you could target these lows, which also are pretty good target. However, these lows are the most likely, and then we'll have probably a retracement. We'll have to see in the 1 hour, because now we're going to explain the 1 hour. Let's go. As you can see here, the day turns bearish, right? But when can we determine when the daily is going to do a retracement to a discount premium? Sorry, because here we are in a huge discount. Then we go to the daily, and where do we have it? We have it here, time frame alignment. We break structure. We have this no real retracement. Then where is our next market structure? Here, no real retracement to a discount. Where's our next? Now we do have our retracement to the discount. We once again take this because we're changing market. Then what do we do again? We take this to this. We go to a discount, and then we're starting to range in a huge range since a couple of days ago. Okay, and look what I said. Okay, look at this. I'm telling you, you have to respect your rules because this will happen. If you know something's likely to happen, just respect your own rules. Okay? Respect your rules and you will have higher win rates. Okay? That's what I meant. We never tapped into the low, and it's not this broker, okay? It's not this broker. You can go to a ton of brokers and you'll see we never tapped into the low. In Oanda, equal lows, okay? Here, low, here, equal lows, as you can see, and here, equal lows. So basically, yeah, we did have a higher low here, but in the rest of the brokers, we had equal lows. We never took the low. Okay, we never took the low because it's likely to not take the low, and it's higher likely to take the high, because that's what I already taught you. If we do not have displacement through a low, we're likely to go to the other candle. So you do not want to be in the market. You want to be outside of the market, let what happens happen, and be done. Okay, be done. You do not want to be involved. Okay, so just look it up. I already explained. The weekly will have its time frame alignment with the daily, and it will go from discount to premium. The daily will have its time frame alignment with the 1 hour, and it will go from discount to premium. Okay, and the 1 hour will have its time frame alignment with the 5 minute, and it will go from discount to premium. That's why if we're at discount and we're not outside of the range, we're very careful with shorting here. We do not want to short here. We do not say any continuation. We want to be outside. Okay, we took a scalp, we're out because we're in a discount. Once if we break the range, then we can short it out like a maniac until it collapses. Okay, as long as it respects our rules, because that's the most important. So I already taught you time frame alignment. Okay, I already taught you time frame alignment. It works a ton. It's a very, in the beginning, complicated topic, but if you go to the charts, you put the months or years. I do not know how much time you can put to the market. It depends on you. But if you put the months and years, then you'll end up understanding it. Go to the weekly and daily and see their time frame alignment from discount to premium. Go to the daily and the 1 hour, see their time frame alignment from discount to premium, marking, as I already taught you, your swing high to swing low. And then go to the 1 hour and 5 minute to see their discount to premium in the 1 hour as well. And that is time frame alignment. Nobody will teach you this. I'm doing you a favor because I feel it's my responsibility to help other people as I've been helped by other of my friend traders. Okay, we're a community and we should help each other. Okay, so I'll see you in the next lesson.
Okay, so in this reading, I will be explaining my rules in which I do not enter a trade, or in which if I'm already in a trade, I will exit. As well, I will give examples of what I'm looking for and what kind of price action I'd like to trade. So let's first start with the long side, and I will give when not to enter. So we will not enter a trade when there's a big expansion on 1 hour and we open on Monday with a retracement to the 0.50%. We will not look for a trade in that pair on Monday. We will be waiting to see how price reacts, and we will be seeing until Tuesday a trade. Okay? Second, when we already had a big expansion on the weekly candle and when it's Friday. if it's already a big expansion on the weekly and it's already Friday, I'm not entering, okay? I'm waiting until Monday, and Monday needs to cover the rule that I already mentioned previously, if not Tuesday. Also, if we already touched the 0.50% and we reacted, afterwards, if the price comes down to the 0.50% that same day, I will not enter. If price already touched 0.50% and then it goes up and afterwards it starts going lower that same day, I will not enter the trade. I will be waiting until the next day to see how the candle closes. If the price trades through 0.50% the same day, I will be waiting to see how price closes, and I will be seeing if the next candle takes a form of liquidity and then shows some bullish impulse upwards. If it takes a form of liquidity such as previous day low or 1 hour swing lows and then it goes upwards and structure is still bullish, I will be entering, okay? Final rule, if we took previous day high and we could not displace through it with big closures and then it starts going lower to the 0.50, I will not enter at 0.50 because we're taking a form of liquidity and then we're going lower. It's not we're going lower to a retracement to go upwards. It's because we're going lower most likely to reverse. Okay? Now, when to exit a trade? When we tap 0.50% in that day, we react upwards and then the price starts to push downwards that same day. We will be moving the stop loss to our entry price so we do not lose anything. And if it goes back there, well, we will be exiting, of course, at a break-even trade. But, however, if it goes upwards and then the next day it comes back to the 0.50%, I will not be moving my stop loss, okay? I will be moving my stop loss again to the structure, and if price goes back to the 0.50, it's okay, there's no problem. However, I do not want to see price go to the 0.50 the same day. It can go another day, but not the same day. Go see into your charts, you'll understand why I have this rule. Next, you're already inside of a trade. From the beginning of the expansion, you took previous day high, and we could not close above it with impulse. We will be exiting the trade if it's already a big expansion and we took the previous day high, we only took the liquidity and then we're going downwards, we're exiting. We will not be guessing if, oh, okay, maybe it's gonna push again. No. We take our profits, we exit. We see if price does anything else later on a separate day, we will be re-entering, okay? Final rule of when to exit. It's Friday. We already have a big expansion on the weekly and on 1 hour that same day. Okay, so we already have a big expansion on weekly. We already have a big expansion on 1 hour. So we're looking to exit because basically weekly is overextended, 1 hour is overextended. We will be exiting. Okay, that's the rules for the long side. Now we're going over for the short side. Basically, the rules are the same but flipped. Okay, the rules are the same flipped for shorts. So we will not be entering if we already had a big expansion on the 1 hour and we open on Monday, pushing back to 0.50%. We will not be looking for a trade on Monday that same day. So this is, if you already notice the pattern, This rule is basically the one of exiting. We will not be entering on Monday once we have a big expansion on the 1 hour, which is the third rule of the of exiting a trade. And if it pushes to the 0.50%, I've noticed that most of the times it will at least take a form of liquidity. Doesn't mean we're gonna reverse, but we most likely will break the structure, make a liquidity grab, and after we take the liquidity, we will be going lower. Okay? It doesn't mean we're gonna be bullish. It can be, but most of the times it just takes liquidity, goes lower. So it's pretty dangerous to stay in a trade when it's overextended, because price will make liquidity grabs some of the times. Some other times it will continue, but if it continues, it's not gonna continue infinitely. Okay? We already had, second rule, we already had a big expansion on the weekly and on that specific pair, and it's Friday, no trade. We took already, third rule, we took already 0.50, we reacted, later on price goes back upwards to the 0.50% premium, and it's the same exact day. We do not want to enter. Why? Go to your charts, but I will tell you this so you see the hint. If we push the same day through the 0.50%, most of the times we do a very big push upwards. And that day we may even push to an order block. It doesn't mean we're gonna be bullish, but most of the times we do. So either we lose or we're gonna be entering on a bad positioning, and we could enter on a very bigger risk to reward. So we will be skipping that trade. Okay. Fourth rule, price trades over 0.50% the same day. We will be waiting for the closure of that daily candle and the next candle to take liquidity, like I already mentioned, and show movement downwards. Fifth rule, we took the previous day low. We could not close below it with big impulses. When I mean close below it, I mean on the 1 hour. And if not, it starts going higher to the 0.50. We do not want to short that. Now, rules of when to exit. We already tapped 0.50% in the same day. We reacted the price, and then it starts to push the same day. We want to exit. We want to exit that trade. If it taps the 0.50%, we will want to exit the trade, because it's the same rule as I already mentioned of when not to enter. If it taps the 0.50% and we enter there, and then it goes downwards on our side, and then it starts going up again, it's not going up to tap the 50% and then going lower. No. It's going up that same day, because it's not a different day. It's that same day. It's going up again because the order flow on the day is bullish. So it's gonna go against us. We want to exit. Second rule, we're already inside of a trade from the beginning of the expansion. We took previous day low. We could not close below it with strength, and we start going upwards. We want to exit. Why? There's no displacement through the previous day low, which means we took a form of liquidity, and then price is showing us willingness to go up. Third rule, it's Friday. We already have a big expansion on the weekly and on the 1 hour that same day, which means Friday. So it's already big expansion. Remember, candles do not expand infinitely on the same wick. It's a big expansion, and as well on the same day a big expansion. So we want to exit that same wick at the end of the wick. Okay, that's basically the rules. And as I already mentioned, it's very important to take note of them, because it's liquidity, structure, premium, and discount, our key concepts. With that being said, think about the rules, go to your charts, see what I mean, and follow them. Very important to follow them. Okay, thank you. Okay, now I will be talking about the strategy and explaining it. So let's start. For example, what I would do is I would go through many pairs of crypto, basically the major ones, okay? So take into note Bitcoin, Ethereum, Solana, Polkadot, Avalanche, Phantom, Near, Doge, Shiba Inu, etc. Cardano, all of these big crypto market caps, which have big liquidity, big volume, okay? Not illiquid tokens which can dump and pump 100% in one day. No, because those will wick you out. They will not have clean price action such as this one. Okay, these ones have clean price action, predictable price action. The other ones might do this. Boom, 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 because there's no liquidity. Once someone enters the market, it goes up, down, up, down, up, down. We don't want that trash. We want predictable markets. Okay, so focus on the major ones, like I already mentioned. Then the second thing I do on my strategy is, this is something no one will tell you, but if you close below a previous week high, the next thing that will happen most likely is we will go for that same candle, the previous week on the new week. This is a new week, March 18. We will be going for the previous week low because we took the high and we closed below. Now we are going for the low. If we close above a previous week low, what are we looking? The opposite, for a high. Now we go for the highs. There we go. If we close above it, we're looking for the high. In this case, it does not take the high. It just goes lower. And what it does next, it takes the low. So we're expecting again what? The same thing. We take the high. In this case, we took both. What are we looking in this case? In this case, we're looking for 1 hour structure or daily. The same patterns on daily. On the daily, it happens the exact same thing. I'll show you. So on the daily, we have the same. What happens here? We closed and it's Sunday. So we're expecting this low to eventually be rated. This is what we're expecting on the new week. So it's open on Monday, boom. We take the high, but it's not this high, it's this that we're looking for. We take this high, which is a form of liquidity, and we close lower. And eventually we take it, we closed above it, okay? What are we expecting? We're expecting this high. And eventually we take both, either this low and this high. So now, in this case, what we'll be looking? We will be looking for 1 hour to see what's the structure. In this case, what it did, it's bullish. So we were expecting higher prices, which eventually we did. You see what I mean? We trade weekly liquidity with daily liquidity and 1 hour structure on that liquidity. Pretty basic. But you need to have all of the concepts that I already explained. You need to have premium and discount, fair value gaps, order blocks, structure, relative strength, to know which pair is the strongest among all of the pairs that I already told you to trade. I already showed you which pairs to focus on. All of these concepts that I already explained, you will be going through it and you will be selecting your pair. Now, once you select your pair, you will be doing what I just said. If you do not understand it, go over that part multiple times until you understand it. I will be saying one more time. If we close below a previous week's high, we're expecting that candle's low. If we close below that low, we're expecting this next low, and the next low, and the next low, and the next low, and the next low, etc., etc. Are you telling me that it doesn't work? Look at this. Did we ever take this low? No. This high? No. What did we do here? We took this high, we took this low. So it took up a lot of weeks. It basically took a few months, about 3 months, but we eventually got there. Okay? Now, are we not going to be trading here? No, of course not. We can be trading here, of course. We can look for trades on the daily. On the daily is the exact same thing. If we close above it, what are we expecting? We're expecting these highs to be rated, and the next thing right here and here. You understand, right? This is the strategy. We mix it with the 1 hour structure, and we're looking for the order flow. This is order flow. This is how the price is moving. It's closing lower, we're going lower. It's closing higher, we're going higher. And the structure is our entry. That's how we know where we're entering on, where we can get invalidated, and our bias is on the higher time frame, daily and weekly. Pretty basic. Now, this might seem confusing at the start, but trust me, you do not need a 4-hour video to understand. What you need is 20, 40, 50 hours of looking at the charts, seeing what I just explained in these few minutes, going over it, and once you go over it, that I already said, look for the previous week highs and lows. If we close above, we're expecting high. If we close below, we're expecting lower. If we take the high and we close below, we're expecting lower. If we take the low and we close above, we're expecting higher. Same thing on the daily. Weekly is the big dad. Okay, weekly is the big dad. Daily, what will daily tell us? Daily will tell us when weekly is likely to fail, and also the 1 hour will tell us where the daily wants to go, because the daily is gonna take a lot. Remember the time frame alignment that I already taught you. Daily is gonna take a lot to play out. Weekly is gonna take all of the week, but the hourly, we can see where we're moving through. We can see little by little where the price is pushing. For example, right here on this week, we took some trades on my Discord. If you want to enter the Discord, I could, but tell you about it. Okay, just let me know. But for example, here, are we expecting lower prices? Yeah, sure. Some people in my Discord were expecting lower prices. However, I told them, careful, very careful, because we're in a discount. First of all, in a discount of the weekly. Second, the 1 hour, remember the rules I've taught you. There are rules to follow for a simple for a big explanation. We touched the 50, okay. Did we go there the same day? No. We went there the other day, okay. We tapped into it, we went lower, okay. But what are we doing here? We're going higher the same day. So once the price steps it, goes lower, you're out. You're out of the trade, basically. Even here, if you traded in here and then price starts pushing higher, you're out of the trade. Because price should not push higher. And here you can see the reason. I gave you rules to follow, and you should follow them for a reason. Price goes there, it can go another time, another day, but it cannot go that same day and push through it, because that means the order flow is bullish. And now on the weekly we're still bearish. Yeah, some people in my community were still bearish, but look at this. We're closing above, perfect. We're closing above. Now the 1 hour is bullish and big expansion with fair value gaps. So are we really thinking that we're just gonna take this and then we're gonna continue lower? Not really. Why? Because this is big impulses. Daily is with our time frame. Also, we're having extremely bullish on a discount of the weekly and the daily. And the 1 hour is looking extremely bullish order flow, making higher lows, higher highs. There's no reason to think that we're just taking this liquidity to go lower. Okay? That's all of the confluences we're looking for. That's how you trade. You look for confluences and you mix it up. You can't just look for one pattern and think, oh yeah, I'm gonna trade this. No. You have to think over it. You have to think, okay, weekly is doing this, daily is doing this, 1 hour is doing this, We're in a weekly discount, we're in a daily discount, 1 hour's looking bullish, daily is closing above previous day candles. Okay, I'm thinking weekly is likely to not go for that low and form a swing low, because that's a swing low. Basically, a swing low is previous candles higher and higher. Look at this. We could be expecting for this to go lower, right? Let's go to the daily to see what could we have seen. We close above this candle. Okay, on Monday, what would we do? We take this, we form candle closure above that low. Remember, it's the same as the weekly. And now, let's see this. So we're having the same exact thing that I already mentioned. We're going through it to the order block, yeah, whatever you want, then it goes lower. And then again, but structure still bearish. We will be waiting a little bit more on this one. So basically, you could enter right here. Once we break this internal structure, yeah, you could. But in my experience, it's best to wait. We just wait. So we wait, we wait, we wait, we wait that whole week. No trade that week on this pair. We do not know Ethereum, Solana, Phantom, Polkadot, all of these. We do not know if they were trending already. But on this pair, there was no trade. Now, once we do break it, right here, what are we looking for? We're looking for weekly, daily, and 1 hour order flow. In this case, we could be waiting until here. Now, here, no, nothing. Now here, there we go. So, there you go for your first trade that you could enter. It's a new week, actually, new week. And it's weekly forming a swing low. You could be expecting that. Now, are we just gonna make all of this impulse and afterwards are we just going to go and trade all the way downwards? Not really. It's more likely to continue higher because 1 hour is bullish, weekly is bullish, daily is bullish. So once the new day opens right here at this hour, actually the new week actually opens right there. It taps what? 0.50%, and then what do? We start rallying. Okay, that's basically what we're looking for. That's how we trade, my strategy, and it works on every single pair. On every single pair, of course, of the ones I already mentioned. I do not want you to go trade all of that no liquidity trade pairs. Right now it's happening the exact same thing. Now the question is, okay, we tapped into what? We tapped into the 50 previous day. Perfect. Now we're tapping into it right now. Now we could enter right here. Yeah, we could. However, there's another multiple pairs that I trade, such as SHIB, such as DOT, etc. So I will not be looking into those when I have stronger pairs, you know. I would prefer trading Polkadot that looks much bullish. Then I would be preferring to trade Ethereum in this case. Of course, all of them have bullish structures, but some have more bullish than other. Okay, some look more bullish, some look ranging. So you understand what I mean. You will be going all over these pairs, you will be evaluating, and after you choose which pair is the strongest, you will be entering on that pair. Understood? So that's all that I have to tell you, and that's everything that you need to know to succeed. Master it, and that's what you need, nothing else. With that being said, thank you. Now I want to end up this course, and I hope you enjoyed it, with psychology. So psychology is very important in my opinion. Why is it very important? Psychology is very important because, especially in your start, you will lose more than you win. Okay, that's our reality. Because you will not understand how markets work most of the time, and you will lose. There's nothing wrong with losing. Okay? Losing is part of the learning curve. You will lose, it's okay. Don't feel down with it, okay? Lose, get used to losing. Get used to losing your money, especially don't demo trade. Lose money. I don't know how much is enough for you that you can say, okay, this is the amount that I can put to lose, but lose money. Don't feel anything about it. Once you don't feel anything about it, you will be able to trade efficient. If you trade efficient, you will win all the money that you lost. Okay? So lose money. I don't know, maybe say, okay, I'll lose $100 and put it into 10, 20 trades, for example. Lose $5 per trade when you lose. Lose. But if you win, then you're gonna be winning and losing and etc. So it's gonna be more than 10 or 20 trades, of course. But get used to losing. And when you lose, don't just say, I lost, it's okay. No. When you lose, go into the chart. Go and look, why did I lose? What happened to the price? Then note it into your journal. Learn about your mistakes. And start noticing once it happens again. Okay, this happened. And if you notice a pattern in which you're losing a lot of times to that specific pattern, be careful. Do not do that again, of course. Maybe even reverse it. Say, okay, when I lose, this happens. I'm gonna start doing the opposite. And now I'm gonna start winning. That's what I've done with multiple of my trading. I learned a lot from my mistakes from losing. So I lost. Now I don't do that. And some things I even do the opposite. So now I win when I do the opposite. Losing is very important. It's only the people that are fake gurus that say, oh, I win $50,000 every day and blah blah blah. Yeah, they never lose. But they don't never lose in their demo account. But in reality is, even the best traders, I do not consider myself the best trader in the world. I'm sure there's better people that had more experience than me. But these people will lose. But it's not when you lose that it matters. It's when you win. When you win, you make sure that you win more than you lose. And that's all. If you can win more than you lose, you win money. Simple math. If you win 10 times and you lose 7 times, but when you win 2 times what you lose, do the math. 10 times 2, 20. Minus 7, 13. So you're winning 13 times the loss. So you're being profitable. That's what matters. Okay? With that being said, thank you for assisting the course. Remember to study, to trade, to lose, to don't care, and learn. With that said, take care.